Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Council. It's Thursday, August the 29th. Welcome to our Global Markets Commentary. August, like July, brought a whole pile of volatility to capital markets. However, if you took an extended summer break and look at the 2-month results for July and August together, you'll be pleasantly rewarded with mid-single-digit results from most equity markets and a solid 3.5% boost from the Canadian bond market. For those who didn't take a summer break from watching markets, we witnessed the somersault that markets took between mid-July and mid-August. Like Olympic and Paralympic gymnasts, the capital markets stuck the landing. The weakness began with some softer economic data. After 2.5 years of tightening monetary policy, investors are leery and on watch for economic weakness. Next, it was a bit of a messy season for corporate earnings, especially the large-cap technology names. The NASDAQ index, where many of these businesses are heavily represented, saw a drawdown of 13% from its July 10th peak. The extent of the downdraft for the S&P 500 was kept under 10%. Markets less exposed to the mega-cap phenoms saw much milder drawdowns. For the equal weight S&P 500, the Dow Jones Industrial Average, our S&P TSX Composite, the drawdowns were in the 5 to 6% range, half as bad as the high-flying NASDAQ, and pretty run-of-the-mill stuff for stock markets. Exacerbating the volatility was an unwind of the Japanese carry trade. After decades of low interest rates in Japan, many large investors, especially hedge funds, have borrowed heavily in yen and used those proceeds to invest in other assets, including U.S. technology companies. The Bank of Japan surprised markets with a 15 basis point increase in its primary policy rate, which sparked a sharp currency appreciation and a mass unwinding of this yen carry trade. The result, a 26% peak-to-trough drop in the Japanese Nikkei stock index, including a one-day fall of over 12%. I'd call that a crash. An additional concern was the U.S. Federal Reserve. The July 31st meeting saw no rate change and only mild movement in their tone. Investors are acutely concerned that the Fed has fallen behind and should cut interest rates promptly to stave off economic weakness. The Fed's tone deafness in the face of market weakness piled onto the situation. By August's end, all of these concerns had abated. We believe recession dynamics are not firmly in play. Or if they are, they could be quickly reversed by the Fed and other central banks cutting interest rates. The U.S. labor market is cooling, but is not a source of downward momentum, as is feared. Other economic data have been soft to stable, with pockets of resilience still to be found. Overall, the indicators are more consistent with a soft landing than an impending recession. Beyond the underwhelming earnings for selected mega-cap names, earnings season has generally been fine, and earnings outlooks remain constructive. The unwinding of the yen carry trade seems to be over. Both U.S. and Japanese equity markets have recovered handsomely. The NASDAQ and Nikkei are back to their June levels, which is up about 15% on the year. The Bank of Japan has made overtures that they'll be mindful of market volatility and financial stability going forward. Talk about an oops, my bad. Like the Bank of Japan, the Fed quickly moved to change its tune. Imminent and multiple rate cuts are now expected. We see a global economic backdrop where inflation is no longer the main worry, the U.S. economy is cooling as desired, and the rest of the world is poised to pick up some slack as many central banks are fully engaged in loosening monetary policy. We are still coming off weak earnings from 2022 and 2023, and belt-tightening on many fronts. Business spending, housing, and manufacturing have all been restrained by global central banks' lengthy and sharp rate-tightening cycle. A rebound and some release of pent-up activity in these areas is our expectation for the quarters ahead. Capital markets are driving solid results year to date in anticipation of this outcome. They are pricing in the expected response to a post-inflation, easing monetary conditions environment that sees economic growth stabilize. That remains a fertile environment for investors. Simply because the equity market had a summer somersault, it doesn't mean markets have fallen off the beam. That's the way we saw the month of August. Thank you for joining us. We look forward to you tuning in next month.